developing story. How have you been thinking about all of this?
Well, it's one of those things that leading up to it, you wondered, is this going to be delayed, as we've seen in the past with the tariff announcements, that it was going to be the day of the inauguration. That got delayed. Then it was going to be February 2nd or whatever it was. That got delayed. And was this going to be another delay? And here we are today, and no, it's not. So this is kind of the plan B, if you will, which you wanted to implement well in advance of the announcement of the tariffs, which is build in defense into your portfolio for the potential worst case scenario that we're seeing today. And that means adding a little bit more to fixed income, adding a little bit more to gold, reducing some of the trade sensitive areas of the market, in particular U.S. stocks. And that should help backstop the portfolios to mitigate some of the volatility. It doesn't eliminate all of the volatility, but it helps reduce some of the downside risk.
I mean, in Toronto this morning, it's hard to avoid this weakness just about everywhere. I think some of the gold stocks managing a little bit better, but tech is very quickly being hit quite hard. I was talking about the U.S. names, but the Canadian names as well. Some of the Bloomberg intelligence team members saying that's in part because a lot of these tech companies are global. They got factories everywhere, and so it's pretty interesting that Trump came in with a sort of a rah, let's make, America the tech leader of the world. And here now we've got this great uncertainty for the tech sector. But for those stocks that have had such huge runs and had such a impressive growth trajectory, does this now become this catalyst for investors to get out of those names? Or is it really just more, to your point, like a recalibration to say, okay, if I didn't have that defense, I got to get a little defense going here, and then we'll see what tomorrow brings?
I think it's a little bit of both.
Okay.
Certainly, if you follow what's been going on with the Mag 7, in particular Tesla and NVIDIA, they've suffered significant drops. Now, I think those have become a victim of the valuation. Valuation, we would argue, has been stretched for a number of names for a while. And it's like a rubber band. You pull that rubber band so far, it's going to snap back. And I think that's what we're seeing. At the same time, I think when you do see the market sentiment turn to be more defensive, then the first thing they're going to sell off is the source of greatest profits. And these stocks have also been the source of greatest profits over the last couple of years.
So I was talking with a guest earlier about how long this lasts. And nobody knows. Right. Nobody knew we'd necessarily get to this point. But if you're having to now figure out where the market rhythms take us during this period, you have to make a bit of a bet on how long this lasts, I would imagine. So what goes into positioning? If you're positioning to be more defensive, is that you're positioning to be more defensive for the rest of the year? Set that so that you can have some peace of mind? Or do you have to be ready for people? I heard the word buying opportunity this morning as well. So
yeah, and I think you have to approach it that way. So you can't come into it thinking, well, if this lasts 3 months or 6 months or whatever it might be, because who knows? It could be over tomorrow. It could be over in a week's time. Rather, we're coming at it that the longer these last, there's going to be a hit to earnings. And in the United States, the estimated hit to earnings is about 5 to 7% off of the current estimate. So if you think 2025 is going to generate 14% in EPS growth for the S&P 500, knock 7% off of that. Okay, so if you knock 7% off of that and then say sentiment and momentum take the market down on a valuation correction, so we could see potential downside from here of 10 to 15%. So in my mind, rather
for the
than
10 to 15% for the broader stock market?
For the S&P 500, exactly. Okay. And perhaps less for the TSX.
Now, I will point out, like, if you're talking 10 to 15%, that sounds to me like correction territory. Yeah. But is it not fair to say that we actually haven't seen a correction in this bull market up until this? Like, usually, there was some data I was citing this week, like since 1928, usually every 1.1 years, you get a correction. Mm-hmm. And some would say it's actually a pretty healthy thing to see in a stock market.
Absolutely, especially with the S&P 500, given its valuation. Now, you never know what's going to be the catalyst for a correction. Maybe this is the catalyst. But if you take the drop in earnings and then just the inevitable correction that we would have seen at some point probably this year, that will take us down potentially 15%. At that point, I think that represents a good buying opportunity.
All right. Just on Canada, maybe it's a two-parter. I know we're running out of time here, but you talk about getting caught maybe not being so defensive in your portfolio. I think our country it is sort of being exposed right now for not having a growth plan for the future. And there's a lot of talk right now about this being a great moment to deliver on that. But we will find, I mean, outside of fighting back with tariffs, I think what we're going to have to find out is if there's any fiscal support here, is it the kind of fiscal support that actually helps us to grow industry for the future? But that's a conversation for another day. It might be a day in the next couple of weeks, but it's a conversation for another day. But how do you think the Canadian economy is going to fare through all this? And how do you think the Canadian stock market will fare through all this?
Great. Two separate things. One, the Canadian economy, if you look at the Bank of Canada, they estimate that it's going to be a 2.5% hit to the Canadian economy. So, that's going to send us into a moderate recession in 2025 if these tariffs last the full year. From the stock market perspective, it's completely different. And I'm surprised at the reaction on the TSX because there are few listed companies that are actually sensitive to tariffs because most of our companies are services companies.
Yeah, it's a very important point.
Yeah, and so to see the banks down like they are tells me, hey, we could be approaching very, very quickly a very attractive buying opportunity for Canadian stocks that could see a very sharp rebound at some point.
Okay. Philip, good to have you with us. Appreciate the perspective as always. Thanks very much.
Thank you.
Philip Petursson joining us with his insight on